What's up, everybody? Joe Brown here. This is the Heresy Financial Show. On Tuesday, some key Fed people came out and said, hey, we're going to get very aggressive with fighting inflation. They're saying we're going to sell assets off of our balance sheet rapidly, starting as soon as next month. And so brace for impact for quantitative tightening. Brace for impact for interest rates rising extremely quickly. That is, if you believe the words that are coming out of their mouths. Ready? Let's dive in. All right, take a look at this. We saw a few people, Federal Reserve Governor Lil Brainard and the San Francisco Fed President Mary Daly talking about how aggressive the Federal Reserve needs to get because they need to get inflation down. So the first thing that I want to look at is what is the current state of the federal funds rate. The base interest rate is going to be the lowest across the curve. And first of all, you notice here that you can't see the interest rate down here in the bottom right-hand corner. It's just not visible. Compared to the last, 70 years where you can see what interest rates used to be, what we're doing right now is clearly not a big deal in light of how high interest rates used to be. But it's not the absolute level that matters for what we're talking about today. It's the change that matters, because if interest rates go from 1% to 2%, that's only, 1% higher, but percentage-wise in terms of the rate of change in the interest rate, you just doubled your debt service cost. So that is significant for an economy that is as highly leveraged as the United States and the global economy, with corporate balance sheets having debt at all-time highs, household balance sheets debt at all-time highs, and the federal government, the national debt at all-time highs. So it matters if the cost of servicing your debt goes up. If we zoom in here a tad bit just to show the line here, we can see a kind of a descending line here from these peaks in 1984, then another peak in 89, another peak here in 95, another peak here in 2000, another peak here 2007, and then another peak here in 2019, 2020. You can see here this kind of descending line on these peaks. And that gets us really, really close to right about, I believe when I plotted this out last time, about 1.5%. If they get to a 1.5% and they can get there by the end of the year, we'll be right about that trend line, maybe a little bit above it. And so my guess is that's as high as they can go, because ultimately, like I said, it's the rate of change that matters. So as they raised rates this time, as they raised rates that time, as they raised rates here, as they raised rates here, as they raised rates here, the rate of change, the difference, the debt service cost for the total economy eventually gets to a point where it can't afford and something starts to break. And so right around probably 1.5%, depending on how fast they do it. If they jack up to 1.5% right now, maybe we have a couple more months. If they take a long time, it might be a lower interest rate that hits that line. But essentially, it's a matter of when, not a matter of if, something breaks, and that change of interest rates, the percentage change, is what matters, and that debt service cost will get too big for somebody that is too big to fail, and they're going to have to walk that back. Next, let's look at what they're saying they're going to do with their balance sheet. They're saying they're going to rapidly sell assets off of this balance sheet starting as soon as next month in May. Now, I don't know what they mean by rapidly, but this spike in assets onto their balance sheet looks pretty rapid to me. That happened in 2008 when they bailed out the banks. And then this spike on their balance sheet looks pretty rapid to me. That happened in 2020 when they bailed out the entire economy. And so when they say rapid, those are the indications of something being rapid for the Federal Reserve, given what they've done for the majority of the years and months during this 15 years that this chart is. Those two spikes look rapid. So anything less than that doesn't seem rapid to me. But just like the word transitory, they're always playing word games, so we'll see how rapid it really is. And we can see here they've stopped adding assets to their balance sheet. They're just rolling over their existing assets. And so for the rest of this month, we're going to see this go up and down a little bit, but it'll be moving sideways like it has been. And if they do actually start selling assets off their balance sheet, it's yet to be seen which assets they will sell. If they start selling treasuries rapidly, obviously you're going to see a big spike in treasury interest rates, which In my opinion, I think they might do that instead of mortgage-backed securities, given how fast mortgage rates have been rising recently and some of the concerns that some people have with the housing market. Ultimately, I've got another video coming out on this within the next couple of days on the real estate market. I don't see any forces right now, even interest rates, that are going to drive housing prices down on average across the nation just due to the supply issues. But in either case, we've got, I think they're going to sell treasuries over mortgage-backed securities because they can, no matter what interest rates get to for the federal government, as long as they're paying interest to the Federal Reserve, as long as that debt is owned by the Federal Reserve, they can they get that debt interest free. So to the extent that the federal government gets to roll over their debt and have the Federal Reserve buy the new debt that they're renewing it for, to the extent that debt moves onto the balance sheet of the Federal Reserve instead of any other economic actors like other central banks around the world, corporations, individuals, that debt becomes interest-free to the government because all the profits from the Fed are swept back to the Treasury. And so it's very possible, let's say just hypothetically, the Federal Reserve says, hey, we are going to, we're going to own all, it wouldn't happen yet because they're bleeding off their balance sheet, but eventually if they say, hey, the federal government can have as much debt as they want and they can borrow from the Federal Reserve as much as they want at any interest rate, regardless of what the stated interest rate is, that's essentially interest-free debt to the federal government because all that interest is just swept back to the Treasury. So ultimately, I think they are going to sell treasuries over mortgage-backed securities, but we shall see. We'll also see how aggressive they get given how volatile the markets are around the world right now. It's yet to be seen how aggressive they'll get, but what will really be the kicker is that the Federal Reserve does start getting aggressive. They start jacking up interest rates, they start selling assets off their balance sheet really quickly, and then inflation persists. It's still 8%, maybe moves up to 9%. What are they going to do then, especially if markets are crashing? They're trying to fight inflation, it's not working, and then all of a sudden the economy, the markets start to crash. Then they're going to be faced with a tough choice. I think you and I both know what exactly they will choose. I will be in Dallas on May 6th through 8th for the Market Disruptors live event. That's Mark Moss's event. He's putting it on again in May this year. I was there last year in November. It was a great event. And this year I'm actually speaking. Love to see you there. Those of you that I saw last time in November in Miami, it was a great event. And we had a good time talking, getting some drinks together. So any of you who are able to come to Dallas this time, love to see you there. I've got that linked in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a good day.